After a prolonged steady share price slump, the three big iBuyers, Offerpad, Opendoor, and Redfin hit an ominous milestone on Friday. Their stocks fell to all-time lows. The milestones come after months of declines for companies across the real estate space. So if you want to know more about this video is for you. For today's video exclusive for our Real Estate Heaven members, we will be talking about the shares of Opendoor, Offerpad, and Redfin, which had hit record lows on Wall Street. The three big iBuyers hit an inauspicious milestone. Shares fell to all-time lows. The share price drops came amid a worsening housing landscape, with prices growing ever softer and mortgage rates ever higher, as the broader stock market has tanked. Real estate company shares have taken it on the nose during these tumultuous times. Shares in Compass, eXp World Holdings, and Anywhere are all laid down too. But over the last 2 days, it was ultimately the iBuyers who set records for their worst share prices ever. After a long period of steady share price declines, Offerpad OPDP, Opendoor OPDR, and Redfin RDFN have all just hit an inauspicious milestone. Their stocks fell to all-time lows. Redfin, one of the country's most popular real estate website, has seen its share price plummet since last year. The company's shares neared $100 amid booming stock and housing markets, trends that buoyed many other real estate firms' share prices as well. But since that time, Redfin's share price has fallen steadily until Friday, when it hit an all-time low of $5.20. The declines then resumed on Monday, when the overall market was once again down, dragging Redfin's price to yet another all-time low below $5 per share. The market slide has caused investors to question whether or not Redfin will be able to bounce back from this dip in the coming months. Some analysts predict a recovery in the next few months as more people begin searching for homes online and more home buyers enter the market during spring break, March 20th to April 11th. Others believe that this drop is just a temporary blip on an otherwise upward trajectory for this company, which has been improving its customer service offerings over the past year by hiring new employees and updating its website with new features like virtual tours of homes for sale near you. Redfin is the most dramatic of the iBuyers, but Offerpad was arguably in the most peril Friday. After debuting on the stock market last year, the company's share price has fallen from a high of more than $13 last September to just $1 during trading Friday. Offerpad's losses has also continued Monday, with the company's share price temporarily dipping below $1. Though Redfin's losses over the last year and a half have been the most dramatic of the iBuyers, Offerpad was arguably in the most peril Friday. After debuting on the stock market last year, the company's share price has fallen from a high of more than $13 last September to just $1 during trading Friday. Offerpad's losses has also continued Monday, with the company's share price temporarily dipping below $1. The New York Stock Exchange is where Offerpad is traded. Because of this, the company must have a share price of $1 or more in order to remain listed on the exchange. If the share price dips below that threshold, it will be delisted, making it much harder to buy and sell shares and potentially warning off investors. This would be a big problem for Offerpad because they're trying to raise money through an IPO, or initial public offering. The company was founded in 2016 by two former hedge fund managers who wanted to create a platform that allowed users to make offers on real estate deals across the country. The share price of Offerpad is flirting with that $1 threshold now. The company still has a month to ensure that it stays above $1. But its ongoing downward trajectory in the market has been happening for more than a year, and that may foreshadow more potential hard times in the future. Finally, there's Opendoor, which went public in December 2020. Like Redfin, Opendoor benefited from the run-up in the real estate company share prices that took place in early 2021. At the peak, Opendoor was getting more than $34 per share. But since that time, the iBuyer has also experienced an overall downward trend until its share price hit just $2.74 on Friday. With the market down and out, it seemed like Opendoor's best hope was to wait until things turned around. But that didn't stop the company from trying to make the most of its opportunity. After Opendoor's all-time low on Friday, its share price came to rest at $2.81 by the end of trading on Friday, a modest improvement from its earlier low. And uniquely among the big iBuyers, Opendoor managed to continue its modest recovery Monday, with its share price climbing nearly $3 by mid-afternoon. There is nothing wrong with being cautious and waiting for the market to rebound before investing in real estate. But it's important to remember that there are some differences between the iBuyers and Compass. For example, Compass has rebounded from its all-time low share price in late September, while the iBuyers have not experienced such a bump. But in any case, investors may be looking with extra skepticism at the iBuyers. In a conversation with Inman Friday, real estate veteran Russ Cofano, currently CEO of marketing startup Collabra, pointed out that Opendoor and Offerpad both got their starts during a time when home prices were consistently going up and interest rates were low. But now rates are higher, and we're seeing forecasts saying prices are going to go down in some places significantly, along with there being fewer transactions. If the investor community is not yet convinced that the iBuyer model can work in a price decelerating market, then you're going to have to impact on investors, Cofano pointed out. There are a lot of questions surrounding iBuying right now. First, some context. iBuying is kind of like a big box retailer for the home buying market. It connects buyers with sellers and helps them find homes in different areas. Second, investors may be wondering if iBuying will be around in the future. Zillow, once the second largest iBuyer after Opendoor, announced it would bow out of the sector, which resulted in all three of those companies cutting their losses, as they were probably not able to compete with Amazon and other giants in this space. Third, some users have complained that it's hard to find homes on Offerpad because they're all sold out and unable to show any listings at all. Fourth and finally, there are users who say that their offers aren't being accepted by sellers and they can't get into many communities where they'd like to live because there are so many people already living there, or because there aren't enough single-family homes or condos available for purchase within those communities. iBuyers only buy houses. Still, the iBuyers' earnings reports are backward-looking, which means they represent performance at a time when the market was not as rough as it has currently become. Meanwhile, investors' potential questions about the iBuying model are forward-looking. After all, if an investor is interested in investing in a company that makes its money from buying and selling homes on behalf of tenants or investors who want to rent them out, or through sites like Airbnb or HomeAway, or even just buy their own home in order to rent it out, they will want to know how much money iBuyers has made doing so. And if a company has lost money for several years running, then investors will want to know why. In other words, if investors want to invest in companies like iBuyers, they have to be willing to accept that there may be certain things about those companies that they do not fully understand, and there may be times when they are better off simply staying away from them altogether. That is the issue right now. Can the iBuyer business model be successful in a rapidly price-declining market? Cofano said. We have not experienced that, and that creates uncertainty. Redfin is another company that suffered from the downturn, but it has a much more diversified business model than Offerpad and Opendoor. Redfin is an agent of real estate agents and brokers who buy homes and sell them through an online platform to help people find their dream home. The company was founded in 2005 by Mattamy Homes' CEO Rich Barton. In 2017, Rich Barton sold his stake to Berkshire Hathaway, which then merged with HCP in 2018. In addition to being an iBuyer, Redfin also owns two other businesses: Redfin Digital Media, which publishes websites and podcasts like Redfin Real Estate News, Redfin Mortgage Lending, and Redfin Trulia Insights, and Redfin Hotels and Travel. Redfin is an iBuyer and a brokerage company and mortgage company, Cofano noted, so they have sort of the trifecta of uncertainty right now. More than anybody because their business model touches on all three of these things. Cofano also noted that Redfin's salary model for agents means it faces fixed expenses even when transactions are down. That's not the case for traditional commission-only brokerages. Redfin CEO Glenn Kelman has said that the company will continue to grow despite its current struggles. In fact, he believes that the company will be able to make it through without needing a capital infusion. The company's business model has always been to use data collected from its website to help home buyers find their dream homes. But when Redfin bought online property search site Opendoor in 2018, it also acquired Offerpad, a service that helps buyers find sellers for their properties. The addition of these two services into its portfolio was designed to help Redfin expand its reach in different areas of the country. However, none of this means that Redfin, along with Opendoor and Offerpad, are doomed. Cofano, for instance, spoke positively about Redfin's user experience during an interview with MarketWatch last month. And the public won't know how any of these companies have fared in recent months until the next round of earnings reports in November. It's been a wild ride for real estate companies, but one that may not be over just yet. The housing market is still in the throes of a historic downturn, and many companies are feeling the effects. But there are consequences for companies that lose a significant amount of value over a prolonged period. Besides the specter of delisting from the stock market, Cofano pointed out that any company with a consistently sagging stock price starts to become a cheaper and easier target for private equity firms or even hostile takeovers. Whether such a future awaits any major companies in real estate remains to be seen. That's it for this video, Real Estate Heaven fan. Remember to subscribe to our channel. And if you feel like we've delivered value, please share this video with one person. That's right, just one person, as a token of your appreciation for the hard work we put into making content that educates and helps you on your mission of building your own fortune. Remember, you can watch video after video, but it isn't until you actually take action that you'll start to see results. See you soon.